You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host. As always, this week we've got our quarterly update with your man, Brendon Ptolomey, Managing Director of Heron, Todd. Brendo, thanks for coming in, mate.
G'day, Trent. Great to be here, man.
It is an interesting time, isn't it, to be in property. It's the start of a new financial year. The last time you were in, we were in the midst of Trump craziness, state election and federal election quagmire, let's call it that. And the market really reflected that too, didn't it? It was 3 months of, I say, stagnation, of people still buying property. Our transaction numbers were exactly the same, 900 to 1,000 every week. People still putting their property on the market, but to a lesser extent, stock on market had started dropping since Christmas, as we forecasted. And it was a little bit, to be honest, of a turnaround on the quarter before, which was showing the first signs of mild softening, even though still really undersupplied. But the difference was in that quarter, in that first quarter of the year, we really knew that was going to be what it was going to be. It was obvious that with all that noise, people don't make decisions in that time frame. So we're well into the third quarter of this year. We've seen what the second quarter looked like. It was a continuation of that drop in stock on market down to what is now essentially back to our historical low ever, which none of us forecasted, not even you and I. And we're back to a position where people are back in FOMO mode. They're nervous about whether they're going to be able to get into property. They're a bit apathetic about even these days whether their property is worth more or not. Before we have this conversation, I wanted to bring up some audio from my chat with Oliver Peterson last week on 6PR from a fella who just gave it to us really raw about what the situation looks like.
G'day, Trent. How are you?
Good, Brad. How can we help, mate?
Mate, get your tea leaves and maybe your crystal ball ready. Where do you see the market in the next 12 months? Because these volatile prices that we're experiencing at the moment, 750, 800 grand for as a median price, where's it going to end? Because on paper we're all millionaires, but for the kids coming through, it's near on impossible, and for the rest of us, it's just clicks on a computer screen. It doesn't mean anything because you've got to sell to buy, and unless you've got multiple properties, it's just getting out of control. But the bigger picture is there going to be a correction? Are we going to come back to some sort of realistic pricing, or is this just what we're facing?
Now, that's a pretty good representation, I think, of where a lot of the market is right now around the barbecue, isn't it?
Yeah, it's pretty interesting, Trent, that he mentions that median house price, because that number does sit at 750 to 850. It's creeping up. Now, the reference point that you and I often use is that we got to the same number as Sydney in a previous boom. Is that where we're going? And so therefore, as he says in the clip, we're all paper millionaires, and what do we do about it? So I suppose you and I are thinking about what the average person should do here, maybe just giving a little bit of confidence about what happens in the market next. I think, just to go back to what you're saying at the start of the year, there's some really healthy activity going on there, but it's typified by the fact there's still no supply. So if we had even more supply in our marketplace, our numbers might even be going more crazy, as in more rapidly increasing in value.
Most of the year, we've seen 1,000 transactions occur every week, and it's only now that we're back to these historical low numbers of low 3,000s that actually our transaction numbers are limiting a bit. Still at 800, still above what our mining boom was back 15 years ago, but it's clear a correlation there that there's less transactions at the moment, even though stock on market keeps dropping, because there's less options for people. We're not just going to buy something we don't want to buy.
No. And so probably the only thing that's changed a little bit is just that East Coast buyer agent sentiment into Perth is reduced significantly. We have talked about that earlier in the year in terms of it dropping away, but it definitively isn't really there anymore. So then when you talk about where our activity is coming from at the moment, it's the good old classic death, divorce and taxes. Essentially, we've got one story in our office about agents in the Southeast Corridor, renowned agent, been in the industry for a very long period of time. I think he's one of those agents that's trying to retire. And he has customers calling him every week saying, when dad are moving to the nursing home now, or unfortunately there's been someone pass away and we're selling the family home, those kinds of scenarios. And he's telling our value in the Southeast Corridor that he barely even advertises anymore. He's got his list of buyers that are looking for property in his location. He hits up the list. If you're not on the list, you don't get an opportunity to buy that deceased estate or buy that downsizer opportunity opportunity that's come up. The reason I'm raising that is that typifies the activity in our marketplace at this point in time, i.e., there has to be an event in someone's life to create supply into the market.
I was speaking to Tom Carlin only a couple of weeks ago about that Coburn Central area. Now, Tom's been in the market for over 15 years as the number one agent in there. And I asked him, why are people selling? He said, they're getting separated.
Yes.
That was the number one reason.
Yeah, I go back to, so we do a lot of family law work in our office. So when I say that, what we're doing is valuations for family law businesses. And essentially, when we go to talk to them, because we're doing our business development with them and checking in and seeing whether we're doing the right job and making sure our prices are right and all those kinds of things, the response we get if we say, do you want to have a coffee, is, I don't have time. They seem to me...
Yeah, we don't need the BD, we don't need the relationship.
Yeah,
we're too busy.
Just get the job done, will you? Yeah, exactly.
Yeah.
From the outside looking in, that sector of the marketplace of our society is extremely busy. And again, that is bringing supply from the fact that there's been a life-changing event, i.e. there's a separation in a relationship.
So I don't want this episode, Brendon, as I said just before we were going on air, to be us banging the same drum, banging our head against the wall the same way. If you want to listen to this as a listener and you want to hear that message, go listen to the last 6 years. We've been saying the same thing. The market's as tight as ever. It literally is right now on paper, and we aren't solving this supply problem. If that's all you're after in this episode, you can switch off now because the message hasn't changed from a quarterly perspective. So what I wanted to do was start to get an understanding of what people would like to know with regards to practical solutions and detail on certain segments of where we can add value in the market. So what did I do, Brendon? I asked ChatGPT, what do people want to hear from Trent Fleskens and Brendon Ptolomey?
Literally, you typed that in there?
That's what I typed in, right?
Okay,
and
let's see.
There were 3 themes. This is what people want to know. 1, Perth's rental crisis, investment opportunities, and tenant strategies in an undersupplied market. So that's 2 sides of things, landlords and tenants. Yep. It's not just about buying and holding property. It's also about just getting a roof over your head too. Do we have any idea as to where most of the pressure, which suburbs are seeing the highest rental yield growth? Is it still the cheaper suburbs where people can afford to pay more rent? Or is it the blue chip suburbs where business owners and a lot of the flush cash is sitting around as well? Yeah.
So what we've been seeing on the ground with our valuers is a lot of feedback from selling agents. We don't talk to property managers as much about rents as you might think, but rents have topped out at about $700 a week, which funnily enough is around about the median rental for a 3/4 bedroom property.
That's what we're seeing as property managers as well.
Yeah, is it? Yeah, so that's great to compare those notes. And essentially what's going on there is the market is saying, okay, well, this is all I can afford out of my salary to pay in rental. And if I can't rent for that price in this suburb, I'll go to the next suburb along and be cheaper. Or I'll go to the share house model. So if I'm a single renting out rooms, those kinds of scenarios.
We've seen a lot of that diminishing return. You're right. It really doesn't matter what you're renting out. It's really all compressed up to around that $7 to $750 mark a week. And that could be in your Warwick, your Morley. But the second you start getting close to the city or close to the river or places that on a sales value are more expensive, are more blue chip, you're not seeing a one-to-one increase in rent from there. People just can't afford it.
Yep. And so then if we go back to that question about investors that ChatGPT wants us to answer, so the answer there is that you're still trying to buy as close to the city as you can, but at a value level that reflects a better yield in relation to that $700 a week rental. So you're essentially going to end up in a suburb like Morley, Warwick, in those northern suburbs, maybe a Baldivis in the southern suburbs, where you are maximising rent, but you're trying to pay as little as possible capital value to get into your investment.
I agree, but I would also play devil's advocate here and say, why are you chasing yield? You're a residential property investor. You should be chasing capital growth.
Yep.
Whether you're making $5,000 a year or losing $5,000 a year on your rent against your mortgage, that's inconsequential. What you want to be doing is making $100,000 a year in capital growth, right?
Yep. And so we're answering the question that ChatGPT asked us. So maybe this is where humans win over robots and we bring in the emotional side of things. Essentially, anyone that's made some decent money on their principal place of residence after they bought into a suburb that they wanted to live in, i.e. I've decided to live here because I like the character houses or the cafe strip down the road or it's close to mum and dad or whatever those factors, you will know that was a different decision to when you went to rent a house and you just said, look, I just need to live in the northern suburbs. It could be any suburb and I know it's $600 or $700 a week and I'll just live there. So we get the split between a rental investment decision and that emotive decision. And what I'm suggesting there is if you're investing in property, in terms of whether you're going to live there or not, if it is a purely investment, then you need to continue to bring that emotional scenario to it. Think it through from an emotional point of view to make sure that you're buying a product that other people are going to desire down the track as well.
I think yield in that space is obviously going to be reflective of your location and the capping of what people can afford. For example, if you're in Mount Lawley and you've got a unit, you could rent that out for $700 a week.
Yep.
You have a house, you're probably only at $800-900 a week more.
Yep.
There could be a value of 200% difference here between the unit and the house. But that yield is going to be very different to, again, what people in that area can afford. Just because someone grew up in Mount Lawley doesn't mean that their income is twice as much as someone from Morley, for example, and therefore their capacity to pay. So just be really cognizant of that and don't price yourself out as a landlord. Just because you think your rent should be higher because you're in a nicer area doesn't mean people can pay more. And if you're getting that higher rent, always check, am I actually getting good quality tenants?
Yep.
And maybe as some advice to the tenant side is to take advantage of that. Recognize, for example, if you're happy sharing in a house maybe with one other professional, to be frank, you could go looking in places like Netherlands, Dalkeith, in a mansion.
Yes.
You can be a professional. You and me, Brendo. If we were single, we'd shack up, we'd both pay $450 a week.
Yes.
And we could rent a place for $900 and it'd be a party mansion between the two of us, right? The reality is for $200 less, you could be in a unit in Mount Lawley.
Yeah, so that price differentiation can get you an exponentially better outcome without spending too much more money. So
if you're not looking at buying property and you're just looking at maximise your opportunities as a tenant, you could live in a baller house for not that much more, maybe with one share.
Absolutely.
Cool. All right, I like that. Let's crack on. Theme number 2.
Yes,
of
from
what
Chat
people want to know from us.
GPT. Yeah.
Navigating rising construction costs.
Right.
Is building still viable in Perth? Are people still doing it? Where are the opportunities? And I assume where are the opportunities as where can I build where I'm not going to be finishing up with a price or with a value that's less than the cost?
Yep. Yeah. So interestingly, we've just been doing some analysis for year to date, as in calendar year to date construction costs, and we can see that they've very much leveled out this year. And when I'm talking about construction costs here, I'm talking about single residential project home builders. So essentially house and land package type scenarios. The definitive theme going on here is that the price range is sitting at about $650 to whatever you like above that in terms of what your ceiling is, but for single residential project home, you're getting up to, say, a $900,000 type scenario. And essentially what you're getting there is land and the construction cost are often relatively the same number. And by that I mean
50-50.
Exactly. So $350 for the block of land and $350 for the build is a really common scenario. The opportunity for people here, if you are in that marketplace, is that there is now availability. So by that I mean you can walk into a large builder in Perth, and we'd always recommend probably that bigger might be better in our scenarios at the moment because we've seen some smaller builders struggling. So you want to make sure that they are of sound capital basis in terms of the builder you choose, and then they are available to do the work is the main point here, i.e. they have a salesperson that will sit you down and say, as fast as you want to move and make choices here in your decision-making process to build a house and find a block of land, we'll be able to build that in 10 to 12 months.
The issue seems to be now finding the block of land again.
So now we're back to where I'll get the block of land. And if you've shopped for your block of land a while ago and thought, cool, I'll put it on there, if that was 6 months ago, you go and find that those blocks are all gone now.
And they're another 15% more expensive. The ones that you're looking to get into now are probably 6 months away from titles. So you can use that time for your planning and your design space.
Yeah, so don't be afraid to ask the builder about whether they've got any blocks that have come up as well. That can sometimes be a scenario where they know of blocks of land, but you need to be a bit price sensitive on that. Probably a question for you, Trent, in terms of being in that space. Have we solved our infrastructure problems here? We're still having issues with getting things like drainage, roads, and in particular water, power, sewer.
Massive issues still.
Yeah, power is still a problem.
We have not solved it. The two biggest proponents that are killing us in that land development space, really, are Western Power and Water Corporation. They are responsible for bringing power and water, and we can't get cleared title to lots until those services are installed or agreed to be installed in a timely manner. And it's that bad that titling is now being held back for things because, for example, the Water Corp can't be sure that they'll have the sewer a year after titles, which is when you'd hope a house starts to get close to needing a sewer. Right?
Yeah.
We don't want to be in a situation where your house is built and there's no sewer connected.
We've heard those stories you and I have talked about before where the house finished.
It's called tankering.
Yeah, there's also no power to be connected. So the
We
builders are at wit's end around that scenario in terms of them doing their best to meet their customers' need and then do it on time, as in complete their contract on time, have their product available for their customer, and then they're standing there waiting for Western Power to supply power.
Yeah, at the end of the day, what we know is that the next expansion of land where you'll see suburbs coming up, East Wanneroo, Eglinton, Carnup, these are areas where there are structure plans being developed. There are developers going in, buying land, getting ready to start doing the development. But the power and the water are still not resolved.
Yeah.
Those will be the things holding up our supply, not the builders anymore.
Yes.
Not the developers, and certainly not the demand.
Yeah. Yeah, and then the other part of construction costs that you and I have been talking about for a very long time is built form. So we're talking about apartments. Still got a massive issue there in terms of the provision of builders that are capable of actually taking on construction contracts. So we've seen a few different ideas. People like Edge are their own builder now, so they're building places like Riviere down in Applecross and Dunes up in Scarborough, where they are effectively the developer and the builder. So a different model to what we've seen in the past. We see Finbar continue their development strategy, which essentially they use the same builder all the time, and they're clearly viable, but they're starting new product in places like Great Eastern Highway and at the old Chemistry Centre in East Perth. So there is some product coming out of the ground, which is fantastic, and there's some product that is finishing. So Riviera would be one off the top of my head that we've just done some vals in.
How are those vals looking? Because if you look on realestate.com, it's from $870,000, which must be a one better.
I've got some stats around in terms of analysing this. We went back to look at the Grove on the border of Claremont and Peppermint Grove there, the Blackburn development, and really what we're talking about here is, did the value go up off the plan? And the scenarios that we looked at, they essentially went up by between 7% in value from the off-the-plan purchase price, which was around about 2021. The highest value increase was an 80% value increase in that period of time. And interestingly, that was a low-value product for that location.
You could have just put down your 10% deposit, done nothing, no mortgage, watched the place get built.
Yep.
And if you want, you could sell it straight back to market as it's completing right now, and make $1 million, Brendo.
Yeah, and so I'm talking about the fact that they got in around $1 million and they sold just under $2 million. For the more expensive product is really interesting. So that was the 7% scenario. So someone that got in at high 2 millions sold out. What is that? That's about 3 years later at 3.1. Yeah, it's really interesting. So a couple of reasons to bring that up. Number one is that there's value increase in apartments. And number two, we're going back to construction costs.
The replacement cost theory. Right?
Yes, yep.
That's what it is. Just like with your detached houses, the reason that prices are going up mainly is not significantly because of land. It's not significantly because of affordability. It's because if you wanted to build it again, it would cost more.
Yes, spot on. And one more factor, and it's the boring old topic of supply, but there's no more product as that competing down the road. So if we had another 250 apartments down the road next to the Blackburn apartment complex,
that'd all be coming on at that price.
Then, or more. We would have some price tension between two complexes, and maybe there'd be some competition in the market and obviously some extra supply.
But there isn't for a number of reasons. One, there aren't that many apartment development sites available in those high-end spaces left around Applecross. Two, there aren't any developers with the risk profile to go at it again after all of that.
Yep.
And that is like 5-6 years of work to get that apartment development up at least. Three, there's no builders who could build it anyway. And four, we don't know that there's a market that would pay those prices that are really the same price you would have paid a few years ago for a house.
Yes.
And a really nice house.
Funny you should ask that question, because I do have a bit of data suggesting that some of the off-the-plan potential purchase prices, so we're talking about contract prices on a number of different complexes north and south of the river in Perth, are suggesting some pretty significant value uplift. And what's going on here is that where people are buying in to a complex, and in particular where they're making that decision to downsize, it looks like they're pretty happy to pay the same amount for the apartment that they buy as for the house they sell So does that make sense? So
Yeah,
there was a
swapping
theory
straight in and out.
Yeah, so there was a theory amongst developers that say you do a development in a suburb, say, let's talk about Shenton Park, Shenton Quarter and Montario Quarter there in terms of infill. Potentially people are selling their $1.5 to $2 million single residential house, Shenton Park. Would they take money off the table and put it in their super? Or would they just pay $1.5 to $2 million for an apartment? And the behaviour that has been borne out is that they'll pay as much for the apartment as they would for that they sold their house for, essentially.
Is that helped along because of the concessions on stamp duty for those apartments? Are there concessions on stamp duty?
Most of the time we're talking about downsizers there, and so I'm not sure they're getting too much of a stamp duty concession. I think really what's going on, and really what's going on is decisions of human nature are going, I've got enough super, I've got enough income to live on, I might as well buy the best product that I can buy to replace the house, because maybe one of the people in this relationship wasn't too certain about downsizing, so let's buy the biggest thing and whatever we can afford, not necessarily the most expensive thing, to try and placate our fears on the changeover to the downs. Just to round out the question around construction costs here, so essentially we are on a pathway here where some of these complexes are getting more viable because there's value growth in those end numbers. And so some of the rates per square metre we're seeing on the analysis we've been looking at is, again, I just reiterate, suburbs all over Perth, north and south. We're talking about very good quality products, so mainly this is a downsizer luxury type marketplace.
Warps views on what apartments cost.
Yep, and so the end numbers in terms of what people are paying are rates per square metre on living area. So essentially we're talking about strata living area here of $13,000 right up to, there's plenty of contracts here that represent $30,000 a square metre, some pretty consistent 20s to 25. And just to give listeners a view on or an idea of what sort of total capital value we're talking about here, some of these are ranging from about $1.5 million through to some of the most expensive transactions if they come to fruition, i.e. the complex gets built and these transactions settle. We're talking about $13, $14, $15 million apartments. So those scenarios are high rate per square metre on a really big apartment, probably a penthouse, and they would be close to some of the most expensive product. Yeah,
you wonder where that money's coming from, because it's not like there's that many houses in Perth that are worth $15 million in the first place.
Yeah, so upper end of the market's been really interesting, I think, Trent, for us in terms of transactions at the start of this year. After our last podcast, I was with Connor Shaw, who looks after our prestige residential valuations through the western suburbs, and I kind of went to Connor and said, there's something wrong here. We're not seeing those trophy type transactions that we saw around about this time the previous year. So 2024, we had a couple of $20 million trophy houses. We also had some big blocks of land at $23,000 from memory. So
rich people, where are they?
Exactly. Why aren't they spending money? What are they up to? And funnily enough, we go and do a little bit of digging. Essentially, these transactions just hadn't come across our desk yet. And what they were is Saunders Street, Mosman Park, a sale at $22.75 million that settled in February. In April, Vivian Yap's been in the paper promoting this sale. It's her own house, $21.5 million. Looks like that settled in April. There's another really recent sale just in the last week of $10 million in Irvine Street in Peppermint Grove. And then the other one that stood out to us was actually a land value transaction in Cottesloe on Hawkstone Street. $12 million for essentially a 735 square metre block of land with a 70s type house on it. So this is definitely a knockdown. Yeah, it's livable, but built in 1973. The reason this was significant to us is that that comes out to $16,326 a square metre. So it's a really significant sale in the marketplace in terms of the market and the high end of the marketplace, high net worth individuals saying, I'd prefer to live in Cottesloe, I'm going to buy my block of land in there. The scenario that we talked about around the office, get your opinion on this, Trent. So if you paid $12 million for your block of land, how much are you going to spend on the construction cost on that property?
Well, it's got to be 50-50, doesn't it?
Yeah, that's usually a pretty normal scenario. And then the other thing that happened around this time is we saw some construction loans come through our office in terms of build costs. And so we have seen, I think we're up to 3 or 4 construction loan costs through Cottesloe that are $8 to $12 million in terms of new houses being built. So
what we know is there's a lot of rich people still buying property.
Yeah, and still investing there. And when you profile some of these people, the scenario about how much they're spending on their principal place of residence looks, I'm not trying to be offensive or anything, but it looks relatively logical to what they are likely to have earned in life, so to speak. And so they're looking for that comfortable home. Yeah.
Now, one question that sits here from ChatGPT, what are some strategies for mitigating cost blowouts? Now, the cool thing about fixed price contracts is that unless your builder goes broke, you shouldn't have any cost blowouts, as long as you're aware of what that price will be in the first place.
Yep.
Now, first thing we need to do is, if you're thinking your build is going to be $300,000-400,000 for that family home, think again, get a number of quotes to just get some reality about what it will be. It is 80% higher, in my experience and opinion, since COVID than it was back then.
Yep.
So just be ready for that. That's your big cost blowout in the first place. If,
Yep.
however, you're ready for that, then it's really about, as you said before, mitigating your build risk by picking a builder who clearly has a bankroll to cover any escalations. One of the good things that's coming out in this market at the moment is we're not seeing those massive cost escalations for the build like we were a few years ago, right? If there are escalations, they're manageable within their margins.
Yeah, I'd suggest if they're still out there in the marketplace and have an offering, that they've conditioned themselves to manage that process, i.e. they've had a chance to put prices up, contingencies in place in terms of cost escalation for materials or labour, and they've gotten used to managing that scenario and pricing for that scenario. Yeah. The other thing that people should be careful of is just what it costs to finish your single residential house. In the same way that all of the construction costs went up, everything to finish it in terms of landscaping, paving, internal floor coverings, window treatments and those kinds of things, if they're not included in your contract, other on costs might be air conditioning and heating and those kinds of things, then just make sure you've done a realistic budget around that. That can be something that people get caught up with in terms of financing the finishing of their home.
That was relevant 5-10 years ago, but it's even more relevant now given how much of a sting that number will be for those trades. Let's move on to our third theme. It is interest rates and beyond, what the economic outlook means for Perth property values in the next 12 to 24 months. Now, look, that's what everyone wants to hear.
Especially ChatGPT. Clearly the robots out there ready to buy some property in Perth.
They want to know. And I get the question on everyone's lips when they're at the barbecue is, hey, what do you reckon is going to happen in the next 12 months? And there will be your naysayers, people who are concerned about the mining industry, for example, which is probably, in my opinion, the only caveat to all of the blustering confidence that most of us have in this market, and that is making sure that the rug doesn't get pulled from the mining industry. Outside of that, it's very hard to see, as we've spoken about before, a situation where supply starts to outstrip demand and does so in a meaningful and continuous way for a number of years to soak up the deficit in supply we currently experience at the moment.
Yeah, so in terms of thinking through what's going on in our economy at the moment, there's still a huge amount of investment coming down the pipeline. The scenario I like to look at here is essentially what's the health of the WA economy, what's the health of the Perth economy, and then let's just look at a few scenarios that are making that economy thrive. And number one, we've always got to think about the mining industry. Looks relatively solid from the outside looking in. I'm not a mining expert. I've got plenty of friends in the mining industry. But there's headlines within the last month or so from people like Rio Tinto, people like Hancock. Rio are saying that they'll invest $20 billion in mining construction in the next 3 years. They've definitively announced contracts with Hancock up around the Newman area there. They're worth $1.6 billion. These are all construction numbers, which essentially means people. Workers. And we're not talking about weird scenarios here in terms of projects that are difficult to grasp hold of. What we're talking about is the realignment of a Great Northern Highway, because it goes through the middle of an area that they need to mine, so they need to move the road. It's a relatively simple but very costly exercise that takes lots of workers, right?
And they need lots of roofs.
Yep, absolutely. Mining industry there, in particular, iron ore looks okay. Clearly, lithium is troubled. Nickel, copper are all still in a highly competitive market with other markets, i.e. Indonesia and China, and are a little bit wobbly.
Especially with the tariff chats.
Absolutely. The thing that's happened for us, though, again, and I don't know, is this WA luck or the fact that we do have a diversified mining economy? Anyone that came out of those industries or those sectors of the mining industry have essentially been soaked up by the gold industry, or the gold mining industry, I should correctly say. And so they've soaked up a lot of workers into towns like Kalgoorlie and beyond. So there's a little bit of luck happening in mining there, but it also just bears out the concept. There's projects happening and money being spent, and workers are required right now, and it's difficult to see any of those sectors falling over tomorrow and essentially releasing a whole lot of workers and having a really big effect on people leaving Perth. That's what essentially makes house values go down.
Okay, and that's right. Well, there's two ways house values can go down, really. One, there's less people to buy houses, and two, there's far more houses available than there were yesterday.
Absolutely. Yep.
So you've just spoken about the first bit, whether there's enough people to buy houses, and we expect that to just continue as it has for the last 5 years for the foreseeable future, and that is 800 to 1,000 people every week buying a house. Now, in order for prices to drop, people need to be putting on the market more than 800 to 1,000 properties every single week.
Yep.
Now, we saw that between August and November last year. About 1,200 people a week were putting their property on the market. So the stock on market went from low threes to 5,500 properties. Yep. And since then, it's gone from 5,500 back to low threes.
Yeah.
So clearly, 600-700 people a week are putting their property on the market, not 1,200 people.
Yep, spot on.
And in addition to that, we don't have 30, 40, 50,000 houses getting built a year either. We have 20.
About 20,000. Yeah, when HIA say we need 25,000 per annum.
Yeah, and Tim Reardon and Mike McGowan both say we're not going to get close to solving this problem this decade. So you then pile that on with what we know, interest rates in a cutting cycle now. How and when that happens and how quickly that happens, Cheryl Bullock's just put her finger up to the market and says will happen.
Yes.
Not when I say it will happen, not when you say it will happen. But they have all stated that it will happen.
Yep.
That's where it's going. So with that expectation of where it's going, as well as the reality of people having more money in their pockets to pay for their current loans, maybe an investment property or buy their first home or upgrade, that just means the people that are here can pay more to buy more and therefore will, because they have to, because there's no options on the market. So there's more people fighting for less, and therefore what happens to anything, price goes up.
Price will go up.
So we just don't see that situation right now where a segment in the market is really outperforming in terms of supplying to the market. You know, apartments, there's 20,000 new apartments scheduled to come on. That's not happening. We've fixed the Watercorp Western Power problem around land development. That hasn't happened, right? And we've just closed the borders. No one's coming in anymore. That's not happening either. So prices have to go up.
Yeah, spot on. The other thing that I'd encourage people to look at there in terms of their barometer is how does that consumer sentiment... So Westpac Melbourne Institute still do their barometer each month. I think NAB do a business one that is essentially is going to market sentiment. And essentially in WA, that market sentiment is very healthy and it will continue to go up or get more healthy as interest rates go down, essentially. So people will get more confident about spending more money, basically because it costs them less to go and secure a home loan in terms of those repayments.
All right, so we both agree that we don't expect to see negative growth as a median in Perth. Yeah. Can I ask an inflammatory question? Can the next year something we look back on as a boom? The next year, we don't know what the year after looks like, but the dynamics right now, it looks exactly in terms of stock on market like it did a year ago, which reflected a 20-something% increase in price over that period of time. What's stopping us from doing that again in terms of outcomes?
Yeah, I started out the year on weekends with Jamie Burnett. He nailed me down in that first week of January and said, what's it going to go up by this year? And I'm a conservative valuer. I pegged it at 10%.
We all did. We all thought 10's reasonable.
Yeah, and you look at that over a whole year, we're already sitting at a pretty decent median house price. I think if you analyse the numbers, we've probably already done that. We still need a bit of retrospective or a little bit of time to go past to analyse that number so far this calendar year. So if we're already on 8 to 10% I would expect there to be some decent growth through the spring period. So we're probably going to get closer to 15 and maybe 20%. And I think, it's not too silly to start sitting around going, hang on, if we had 20% growth last year and we'll get another close to 20% this year, then we are now in a boom scenario potentially where the rearview mirror is going to bear out that property values had a significant growth phase this year and last year. Yeah,
which is hard to fathom because normally for there to have been a boom, there needs to have been a bust.
Yep.
There needs to have been a period where people were hurting. We had 3 months maybe of where it wasn't called a boom.
Yep.
That was it.
Yes.
So it's really hard, I think, for people to get their head around the expectation or idea that it can happen again, that 2023, 24 can happen again, give late 24 the only time where it wasn't happening.
Yeah, yep. And I think there's still some burn in the marketplace back from the 10 years ago where we had a correction in prices. People that are looking to make decisions at this point in the market cycle think they've probably missed it. Probably encourage them to go and look at the scenario back then when same thing happened in 07, 08. You sit around going, it can't go any higher. But we did, in fact, see values continue to increase. The only other factor here is that we haven't talked about is everyone's confidence around their own wages and everyone's confidence about their employment position, which are both still very high in the Perth marketplace. Again, if you go back to those fundamental economics of the projects coming on board, some other scenarios around $8 billion in AUKUS, $5 billion being spent out at the airport, the state government spending significant amounts of money in power infrastructure, finishing off those Metronet programs and road expansion programs. Certainly construction jobs will remain very healthy as well into the future, and that again bears out the concept that there's confidence in the marketplace.
We saw in the paper some reporting that the Western Suburbs was seeing weakness. Now, I talked to the ripple effect of how the Western Suburbs leads the way here. Saw a 10% drop despite the fact that we've seen some record prices continuing to happen. What's going on there in the Western Suburbs when you see that median data being reported on? Is it dirty data? Does it reflect what's going on the ground? Is it correct? Because it doesn't speak to everything we're experiencing across most of Perth.
Yeah, I would say that it's a lack of data. So essentially, there's not enough sales evidence coming through the system there to bear out what's happened in the previous quarter. So if you're doing month by month, quarter by quarter, year by year, you've got a lot less sales transactions, and it's not always going to reflect that from one month to the next month that it went up in a linear fashion, because you've only got 10 sales. One month, you might get those 10 sales and there's
they're
one
on the beach.
Yeah, they're all on the beach, and say half a Marine Parade sells. So you get 5 sales, those ones we're talking, $12 million. That significantly overinflates the median house price. The next month, if you lack one or two of those $10 or $12 million sales, then the median house price is going to look like it dropped. So essentially, it's a quirk of the statistical analysis.
That seriously, that reporting?
Not at all, no.
And we always speak being cautious about the ups and the downs with this data that comes through, because it can be extremely dirty or just lackluster.
Yeah. And I looked at the listings for COT on Monday morning. Pretty much everything listed is under offer. There's a few houses on the market. You can't buy anything in there unless you go and talk to all the agents and ask to find you something that you're looking for. The barometer that I look for in there that I think has been a big change from last year to this year is the sale of vacant land, essentially. Bowl over houses, they are frequent. They're happening every weekend, and that a lot of confidence in that marketplace, because people are now saying, I'm happy to go and buy a bowl over and engage a builder to build a house. And those underlying land values in COT are as much as $3 million for a block of land now.
But that speaks to people's future expectations that I'm going to bowl it over and then spend the time and money exorbitantly building on it, and it will still be worth more or the same in 2 or 3 years. Yeah,
and so that essentially is a $5 million type of exercise at this point in time, and that's essentially what I'm trying to say about that confidence in that marketplace. So to get back to your question, I'd be ignoring the statistical anomalies that come out because of median house price and lack of transactions. If you go and do that same scenario to Peppermint Grove, another small suburb down the road like North Fremantle, they always throw up these quirky concepts when they get singular sales that essentially skew the median.
That could be one transaction a quarter in Peppy Grove.
Spot on, exactly.
We're going to meet up again in October to chat about what's happened in Q3. What will we be saying, probably? We
should have a pretty fresh interest rate drop, I would have thought. It'll be very interesting because I feel like sometimes we get a bit detached to the East Coast economy here in Perth. So it'll be interesting to see whether the RBA feel pressure that they missed the boat recently and that they have to go to half a point drop. That'll be a very interesting scenario. I just think that we'll essentially be talking about spring season, lack of supply, lack of choice, what are people's options. But let's see what plays out over the next few months and see what motivates people to bring their property to the market.
It's not a good position to be in when mobility is the problem, Brendo, and we don't want to be in a position where people can't move because they don't have options. And obviously that spirals onto the rest of the market. So, yeah, fingers crossed that we've got a bit more stock on the market so that everyone can live their lives and make the choices that they want to make.
Yeah, and hopefully we're also talking about starts on some of those apartment buildings. There's a few, I know...
Let's hope Richard Pappas' one on the corner of Alma and Fitzgerald is up.
Yeah,
that time as
well.
So
I think there's a few contracts and negotiations going on around the place of a few different locations in Perth. So it'd be really good to see those complexes started, essentially, because that really does provide some hope.
All right, mate. Thanks for your time.
Cheers. Thanks, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!